All right. Hello, everybody. This is Mike Rixey again with NetPicks, and I wanted to get a video out here today. I'm going to be releasing this video for both our NASDAQ and ETF Option Superstars program. So the reason I wanted to get this video out, I've had just a ton of questions come in over the past few trading days. It's been a wild ride in this market. I have been active since 2002, and I've only seen a couple other instances where we get this type of price action, enough to where we actually had a trading halt this morning, which I'll talk about in just a moment. So a lot of the questions that have come in, what do we do in this market? How do we manage open positions? What are we looking for in new trades? So I want to talk about that in more detail over the next few minutes. The first things to point out, we talked about this over the past, 5-6 months when we had that rally to the upside to all-time highs. I talked about how that was not the new normal. A move to all-time highs week in and week out, a one-way directional move without any type of selling. That was not sustainable. And the higher we got, the more extended we got, the further into bubble territory that we headed. And as a result, we got into a mode where everybody just assumed every dip was going to be bought. People were using leverage to get as bullish as they possibly could get. We knew the Fed was active in the markets. They were doing everything in their power to prop the markets up. Well, as a result, everybody got so long, no one even thought about a correction coming, that the boat got completely loaded on one side. And we know when that happens, the market likes to catch everybody off guard. Now, it took a pretty extreme situation here, right? We've got a global sickness spreading like wildfire right now, right? So we've got the virus, the coronavirus spreading all over the world. That's what it took to get some fear to come back into this market. And when it did, it was just a mass run for the exits. And that's what we're seeing right now. So where does that leave us now? Just as it wasn't the new normal on the upside over the past 5-6 months, this move to the downside is also not the new normal. I know it feels awful. It feels terrible when the market is down, hundreds of points at a time. And in the case of today's session, down 1,700 points on the Dow. You take a look at the S&P down a couple hundred points, the NASDAQ down over 500. It feels like everything is falling apart. This is the type of move when you start to see the panic kick in, where it's get me out at any price point. You're very, very close to getting to a near-term tradable low. I am not saying the low is in for the year. We could certainly see some further selling in the months to come. But in the near term, I would not be surprised if we got another one of those relief rallies over the next couple of days. Not only because price action is at an extreme, but also we've got news out of the White House that this administration is now considering different stimulus packages to prop this market up and try to come to the rescue, for that matter. And we'll see if that leads to anything on the upside over the next few days. Let's transition from just the general outlook to the technical picture. We know the volume has just exploded. I went back and looked over the weekend, took a look at some historical stats to try to take a look at the last time we saw this type of an extended stretch of explosive volume. And it's been a long, long time. In fact, I've only found one or two other cases where volume has exploded like this. On SPY, we went from seeing, between 35 and 50 million shares on a daily basis on SPY on that move to the upside to now over the past couple of weeks. It's basically been over 200 million shares trading on a daily basis. We had some sessions last week where we were up above 300 million shares. This is extreme volume. We know it's not sustainable. Okay, so what does that mean going forward? Chances are we're going to see that tradable bounce where things start to settle down a little bit. The volume starts to settle back down. The volatility starts to contract. I'll talk about volatility more in just a moment. But from a technical perspective, what you want to watch is today's low. Okay, the low of the session at 273.45. That is going to be our near-term area of reference. If that level holds, we could certainly see a tradable bounce. Where would be my target level? The problem with these extremes is that we've got some pretty big air pockets now above us. The gap from Friday's close to today's open. You've got this overnight gap here. I would love to see it fill the gap and at a very minimum get up to 290. That's a $12 move on SPY. I know it seems like a big move, but in this market, It's really not. I mean, we've seen $12 moves in SPY in a matter of a few hours. So that would be my first area of reference. Past that, the 8 EMA, that solid pink line, we're pretty extended from that level. If price action bounces and that moving average continues to move lower, which it will, I would love to see that level tested here over the next few days. So those are areas that I'm watching here from a technical perspective. This morning on the open, well, first of all, we had futures. We had a circuit breaker hit overnight where futures were getting crushed. We hit the circuit breaker, the market halted, and they were basically locked limit down for most of the night. Markets opened, and within 60 seconds, the market had hit another circuit breaker, and we halted again. When that happens, I know it's intimidating. I know it can be scary for people the first time you go through that. It doesn't happen all that often. And for many people, that was a first-time experience here today. I mean, the last time we saw it was back on election night. What I will always tell people, any type of option position that we have on with any of our services, we are always going to be in risk-defined trades. We know what our maximum loss is right up front. And the reason we do that is for situations just like this. I don't want to be caught with unlimited risk. By putting on more conservative type positions with a lot of vertical spreads, are we giving up some profit potential? Yes, we are. But in exchange, we're putting on positions that I know what my worst case is in case we get a market move like this. If you're using proper position size, what is proper position size? We talk about keeping that risk in that 3 to 5% range of your account per trade. If you're using that type of risk, yeah, it's no fun when the market explodes like this because it can be a lot to keep track of. But you have that safety net. Know that if you're using proper risk, if you're using the vertical spreads like we teach, you're going to be okay. Okay, are we going to have some losing trades through this? Yeah, we will. Okay, but things will start to normalize. We're not going to take risk where we're going to blow out an account. We're going to continue to follow the criteria, follow the system, and over time, the numbers will work out in our favor, even though we're going to see extremes in both directions from time to time. All right. So let's talk about what I am looking for going into tomorrow's session. I mean, you can see we're off the lows here going into the close. The internals, you will not see internals this week. And I know I don't talk about internals all that often. These are more leftover from my day trading days years ago. But when you have a volume ratio, minus 30 to 1 on the NYSE, the volume is huge, and it's certainly on one side of the trade. It's certainly on the downside. The volume has been explosive on the downside. We're almost at minus 10 to 1 on the NASDAQ. These are very unusual readings. We don't see this very often. This is very typical of a late stage move. We're at a panic level where everybody's saying, hey, get me out at any price. And we're seeing that reflected in the numbers today. The advanced decline line, we're negative certainly on the NASDAQ and the NYSE. You can see we're currently at minus 2,900. This is not weakness in one or two sectors. This is weakness across the board. Again, very typical of a washout move. And I would not be surprised if we get this bounce. We're off the lows here over the past hour or so. I would not be surprised if we get that rally going into Tuesday or even Wednesday. We're due. Now, whether it's sustainable or not, only time will tell. We'll just have to wait and see what happens. Now, what does that mean for us as far as new trades go? I did not issue any new trades today. Here's why. Let's go over to the trade page here a second, and let me just go to a product like QQQ. This is the NASDAQ ETF. Typically has very tight markets. When I say tight markets, what I'm talking about is the bid-ask column. If you go to the options that are slightly in the money, we'll just go to the 195 calls here. In most normal market conditions, you're going to have bid-ask spreads of a few pennies. There's going to be anywhere between 1 or 3 pennies difference between the bid and ask prices. Look what they're at now. I mean, we're at 25 to 30 cents difference between the bid and ask prices. Those are really wide markets. It's even more extreme on some of the individual stocks. You're seeing some markets, we saw it this morning, where some markets that are typically 20 cents wide were actually $4 or $5 wide, meaning there was a $4 or $5 difference between the bid and ask prices. When that happens, it can make it very difficult to get filled on trades at good prices. Markets are moving incredibly fast, and you don't want to get caught, because if you're having a difficult time getting into a trade, it's going to be just as difficult to get out of the trade. So what I am trying to do here today, I did not issue any new alerts, even though I've got a lot of trades on tap here. I mean, a lot of charts that I'd like for potential opportunities. I'm not going to try to force it today. We're having an extreme outlier type a day here today. I'm going to let things settle back in. Pick things back up tomorrow, even Wednesday. See if we can start to get more of a normal type environment. It makes it easier for us to get in and out of trades at good pricing. So things that I'll watch, how do I know if we're going to have more of a normal session? Well, first of all, we're not going to have the market locked limit down like we saw here this morning. But also, I'm going to take a look at a lot of these bid-ask spreads. When I start to see those spreads start to tighten up, I'll know it's more of a normal type environment. That's going to make it much easier for us to trade. Now, if you're trading here, if you put on new positions today, couple things I want to point out. Sorry, guys, I'm trying to turn trade alerts off on my other computer. A couple things to keep in mind. Trade small. Don't try to load the boat here, guys. There's no reason for it. There's no reason to ever load the boat and put everything you've got into one trade or one series of trades. Keep the risk small. If you're used to risking, 3% of your account per trade, maybe you cut back to 1.5%. Trade incredibly small until we start to see things settle back into a normal environment. Also, let's talk about volatility. The IV percentile. I'm going to show you this on QQQ in the Thinkorswim platform. You can see these stats inside of Tastyworks as well. But what we're looking at here, the IV percentile. What we're looking at is the implied volatility of the options. The implied volatility will tell you how expensive the options are. Okay, the volatility is a huge input in the pricing model of an option. Right now, the volatility is at 52-week highs pretty much across the board. We have seen volatility absolutely explode. What does that mean? When volatility gets this high, the options are incredibly expensive. You're going to pay a ton to put on a long call or long put right now. Let's say you buy a long call option here, expecting the market to bounce. If it does bounce, you aren't going to necessarily make money on that position. If they start to contract the volatility, if the volatility gets crushed over the next couple of days on any type of a market bounce, that volatility contraction is going to prevent you from making money on that option. What does that mean? Well, how do we apply that or make sense of that into our trading this week? I am going to be taking a look at more credit spread opportunities here, because if I sell an option, I want to collect as much as I can up front. When the volatility is high, it means the options are more expensive. It allows me to collect more premium. It allows me to get a higher probability of success on my trade and take what the market is giving us. And right now, the market is screaming to sell premium. So now, instead of buying a long call option expecting the market to bounce, if I sell a put spread and we do get that market move higher, if volatility contracts during that move, I can make money from that. And I can make money faster from volatility contracting. That's why I've been using a lot of vertical spreads here lately, specifically with credit spreads. I'm going to continue to do that as long as volatility is this elevated. Now, IV percentile at 100, what does that mean? Well, it takes a look at the IV levels, the implied volatility levels over the past 52 weeks. It gives you the 52-week high for volatility and the 52-week low for volatility. So on QQQ, the 52-week high is 52%. The 52-week low is 14%. The current level of implied volatility is at 52%. You can see that right here. That's the current level that's being used to price the options. We are at the 100th percentile. We are at a 52-week high for volatility. Over time, the 50th percentile is going to act like a magnet. Price action is going to be drawn, or volatility is going to be drawn to the 50th percentile. So over time, I know that volatility is going to contract. Whether that's a couple of days from now, a couple of weeks from now, we won't know. We'll just have to wait and see what the market does. But over time, that volatility is going to contract. And to put that into our favor, we're going to use credit spreads. So if I take a look at some of the individual charts, here on QQQ, you can take a look in our pulse indicator. We've had the last 4 bars plot yellow. This is the 195-minute chart, by the way. You're going to get 2 candles a day instead of 1. This pulse indicator, it tells us whether price action is at a 1, 2, or 3 standard deviation extreme. I want to see at least 3 out of the past 5 bars plot yellow. We have that here. Price action over the past 4 bars has been between a 1 and a 2 standard deviation channel move on the downside. It does not mean price action has to stall out and has to bounce in a big way. Price action could continue to move lower. It's just not statistically probable. And when you start to see 3 out of 5 bars plot yellow, look what's happened in the past. Look what happened when we had those yellow bars on the upside. It didn't immediately pick the top. Price action didn't immediately roll over when we had those yellow bars. But see what happened as we started to consolidate near the upper end of the range? Price action stalled out, and eventually, obviously, we know what's happened. We started to roll over and we started to pull back. When you get those extremes on the pulse, it definitely identifies for me potential opportunities for price action to stall out or reverse in the other direction. As a result, QQQ is on my radar for selling a put spread over the next few days. That would potentially benefit from a bounce higher in price. If we just chop sideways, maybe we start to consolidate here. Maybe we start to move sideways. I can still make money from that by selling a put spread. The only move that hurts me is a big move lower, which I'm not expecting at this point because we've already seen the big move lower. I would expect things to start settling down a bit here in the days to come. Now, if I start to take a look at some of the other products, here's VXX. This is the volatility ETF. This is going to move inverse of equities. As equities sell off, volatility increases, right? And that's what we've seen on VXX. It's exploded to the upside. And as a result, the pulse indicator went yellow here last week. It then went green, and it's gone blue here over the last couple of days. What does that mean? The yellow bars represent between a 1 and a 2 standard deviation move on the upside. The green bars represent between a 2 and a 3 standard deviation move to the upside. And the blue bars represent greater than a 3 standard deviation move. This type of a move is going to happen less than 0.1% of all occurrences. So if I take a look, is volatility is it extreme here? Is it overbought? Yes. How do I know that? Because only 0.1% of all occurrences will fall outside of this range on the upside. Can it move higher here? Yes, but the numbers are very much against it. The numbers back up either a period of consolidation or a reversal to the downside. All right. So what would I be looking at here on VXX? I would want to sell a call spread. Selling a call spread allows me to put on a neutral to bearish position. It benefits if the stock moves sideways to lower. It also benefits if volatility starts to contract. Okay, if the implied volatility, which we just talked about being at a 52-week high, if it starts to contract, it's going to cause the options to lose value faster. That's exactly what we would want to have happen if we sold a credit spread. Okay, so what is my minimum requirement on the pulse? I need 3 out of the past 5 bars plotting yellow. And then I would need at least 1 green bar or 1 blue bar. Anytime I see at least 1 green or 1 blue bar, that gives me the opportunity to put on a credit spread looking for the market to reverse. So QQQ, VXX, those are names that I'm looking at. We can go down through the list, guys. I mean, there's so many extremes. A couple of the other ones that I was looking at here. You've got Apple with some yellow bars starting to plot on the downside, indicating some oversold conditions. Trying to pull over my list here. Facebook. And unfortunately, my platform's moving a little bit slow here. So Facebook, oversold. How do I know if I'm oversold? We have a slew of yellow bars on the pulse, indicating a 1 to 2 standard deviation move on the downside. We then got the green bars, indicating between a 2 and a 3 standard deviation move on the downside. And then we just today got a blue bar, representing a greater than a 3 standard deviation move on the downside. We are incredibly oversold here. It does not mean Facebook can't move lower. It just means it's not statistically probable to do so. Only 0.1% of all occurrences fall outside of this range on the downside. Odds favor either a period of consolidation or a bounce to the upside. The way that we would want to play that here is to sell a put spread. It allows us to lean a little bit bullish, but by selling a credit spread, it puts time decay in our favor. We make money for every day that passes. We also make money if volatility decreases. So now, instead of buying a long call, expecting Facebook to move higher, the only way I would make money on a long call option here is if Facebook did move higher quickly and it was big enough to offset the volatility decreasing, which is going to happen. Instead, by selling a put spread, it still allows me to be bullish. I'm going to tie up less capital. It puts time decay in my favor. and it allows me to benefit if volatility does decrease. So now, instead of putting on a very low probability trade with a long call by selling a put spread, it's going to give me a much higher probability of success. It gives me multiple avenues to follow to make money. That's what's going to put the odds in our favor. Doesn't guarantee we're going to be successful on that trade, but it starts to stack the deck in our favor over time. So I'll continue to track these markets very closely. I'll be looking for 1 to 2 new trades here over the next 24 to 48 hours. We're not going to do anything new today, but Tuesday or Wednesday, I definitely think there's some opportunities there. If this market starts to bounce, it could be swift. It can happen in a hurry. We'll definitely look to take advantage of that opportunity with some short put spreads. But we'll see what happens with the news cycle, see what happens with the headlines, with this whole virus spreading like crazy. See if the Fed comes out with anything stimulus-wise to prop this market up. So I'll be back with you guys on Tuesday. We'll certainly look to get some new trades on here over the next couple of days. If you have any questions on anything I covered in the video or anything markets-wise here from the last couple of days, certainly let me know, and I'll be in touch right away. All right, so I'll be back here over the next few days. We'll have a more specific video to our open positions and take a look at some new trades potentially. So I'll be back with you guys over the next few days. So enjoy your afternoon, everybody. Enjoy your evening, and I'll be back with you guys on Tuesday with our next round of setups.